everyone, Julius de Kempenaer here with a new video at the start of the week, Monday the 17th of June. I hope you had a good weekend and ready for this week. Lots going on, and I want to start this show with an RRG of the sectors, which we usually do. But I want to start with a daily RRG of the 11 sectors, because something's going on that I cannot remember having seen on an RRG before. If you look at this RRG here, let me just blow this up a little bit. Look at these tails. Pretty much every tail has rotated into a negative heading. It's heading between 180 and 270 degrees. This is 180, this is 270. Pretty much all these tails have rotated negatively, except for consumer discretionary, but even that is not on a positive rotation. Only the technology sector, XLK, is on a positive rotation. And it is the only sector inside the leading quadrant. This is quite remarkable. So we know what happened with the S&P last week. We again went higher. But this RRG shows you very clearly where the performance is coming from. It is primarily, if not only, coming out of the technology sector and a little bit out of consumer discretionary. This is in line with what I've been telling over the last few weeks, and market's still proving me wrong, because in the end of the day we're still going higher. Market's going up, S&P's going higher, XK's going higher. So what are you talking about? Well, that's true, and I see that, and I have no intention to swim against the tide. However, when I see this type of setups, it gets me on the tip of my chair. The problem is that everything on the left-hand side is in a relative downtrend. Everything on the right-hand side is in a relative uptrend. So out of the 11 sectors, there's only 2 in a relative uptrend. And XLC is rotating out, so it's still in a relative uptrend, but it lost momentum and it's very close to crossing over. So the only thing that's left is XLK inside the leading quadrant. And admittedly, it's at a very strong rotation. So in and by itself, the technology sector is carrying the weight of the S&P 500. And you really have to question how long that is a valid proposition. How long will the market be able to sustain this rate of change, this pace, on such a narrow footing? Now, it is of course absolutely possible that the technology sector and the only small groups inside the technology sector that are carrying right now will eventually drive all the other sectors back up, and we will see all these sectors rotating back in and without any meaningful correction. And if that's the case, then we will see it happen. But I feel that this is something that investors really should be aware of. I don't know what the best analogy would be, but it would be something like, walking along the edge of a cliff. That's probably what it is. You don't necessarily have to fall in, but you've got to be very aware of what you're doing. Anyway, so that's the general take after last week, which was a risk on in terms of the S&P 500. But if you look under the hood, a lot of sectors rotated out, because this is 5 trading days, and you can see how at the end of the week, or utilities even, and energy all week, but here is real estate and healthcare, like in the last 2-3 days of the week, are rotating out of favor. So when I break down the sectors, I often do that in 3 groups: offensive or cyclical, defensive and sensitive. And that's what I want to do for this week's video as well. So let's start with large cap cyclical. Those are the cyclical offensive sectors. Those are the sectors that you expect to do well in a bull market. And what you see here is that financials, materials, discretionary real estate, they're all inside the lagging quadrant. Materials and financials definitely pushing further into it. And then here is real estate and consumer discretionary inside lagging. They're picking up a little bit of momentum, but they're at very low readings. So just eyeballing this RRG, reading this RRG, this is not a very strong group. And this is the cyclical group. This is the group that we expect to do really well when the market is pushing higher. It's an orange flag, it's a red flag. Like, you know, hey, you would expect these sectors to do really well when the market's going higher. Market's going higher, this is not going well. Something to think about. Now, let's take a look at large cap defensive sectors. And then you see how utilities are inside the leading quadrant, but they're all already rolling over. Staples never made it into the leading quadrant. And then you've got healthcare, which is inside lagging and pushing up. Not necessarily the best or the strongest rotation, I immediately admit that, but it's looking a lot better than cyclicals, that's for sure. So I'd say this is like, especially utilities, they're kind of starting to digest the long and strong stint that we had over the last 10 weeks. Because look at the length of that utility tail compared to healthcare and staples, but also compared to a few of those cyclical tails that we just saw. And then finally, there is large cap sensitive, and that's where it's getting interesting, because here we have technology, the one in blue, we have energy, we have communication services, and we have industrials. And technology is definitely rotating in. By the way, this is the weekly RRG. The one that we saw earlier was the daily, so that's why you see technology inside improving and not inside leading. But here also something interesting is going on, because those out of these what they call economically sensitive sectors, 3 out of 4 are at a negative heading, and only technology is at a positive heading. So on that daily chart, you saw that last week, everything was rotating out of favor. Only tech was in favor. And now we've seen cyclical, defensive, and sensitive sectors. The offense didn't match the strength that we're seeing in the S&P. Defense is kind of okay, but it's rolling over. Here we see sensitive, and 3 out of 4 are rotating out of favor. Even communication services, which has a ton of very large cap stocks in there. This breakdown again confirms or underscores that the strength of the market right now is coming from a very narrow base. It's only coming out of the technology sector, and then within the technology sector, only from on top of my head, of course, semis and semiconductor equipment, software, and hardware and peripherals. So that's Apple, Nvidia, and Adobe type stuff. Let's take a look at the individual price chart of those sectors. Let's do it in alphabetical order. So we're starting with XLB, that's the materials sector. And on the price chart, we broke to new highs. We're still holding up above that break, but we're now kind of consolidating. And that's taking its toll on the relative line, because the relative line just broke below its previous low. That's a negative. It's kind of confirming that downtrend that we saw here since the start of 2023. And now both RRG lines are rolling over. So from a relative perspective, materials sector is definitely not one of the best. It is what we just saw on those RRGs. Communication services broke to new highs, is still holding up there, But look at the relative line. The relative line, this was one of the strongest sectors over the last year and a half, coming out of this massive downtrend, turned around and really carried on at a very nice and stable pace. But now we're starting to break that rising trend line in the relative strength line, and the RRG lines are getting closer and closer to the 100 line, to the 100 level. The RS momentum is already below it, and RS ratio not yet, but we're getting really close. You can see how this red line is getting closer and closer to the 100 line over the last 12, 13 months. Now here's energy. Energy broke to new highs, held there, but look at what happened the last 2-3 months. We broke back below the breakout level. That is not a good sign. And we're now moving to the first support level, but that's also taking its toll on the relative strength line, because that is now about to break below its previous low if it's not already there. And I could have drawn that dashed line a little further, because we would have had the low of 2022 as well. So here also not a very strong relative picture. Financials, look at that relative strength line. Tanking down, and it's dragging those RRG lines down super fast. We broke up below this. I mean, I was looking at it and I was wondering, do I label this as a head and shoulders pattern? I don't think it is, because it's not really at the end of an uptrend, although it has some of the characteristics. So I'm not going to really officially label it as a head and shoulders pattern, but you do see the characteristics of a head and shoulders pattern, and we do see the break and now the pullback to that breakout level. Given this whole situation, lower highs, lower lows, and the weak relative strength line, I wouldn't be surprised if we see financials putting in a new lower high and again starting to move lower, because this is a really bad relative strength line compared to the S&P 500. And then here is industrials. Holding up pretty well, but look at this. This is potentially a double top pattern. So 120 is where the previous low is. If that breaks in the next couple of weeks, then industrials completes a double top pattern at the end of an uptrend. Usually not a good sign, but look at the relative strength line. Relative strength line has broken a massive rising support line that starts back in 2020. You see that both RRG lines have rolled over. We've taken out to the downside the previous 3 lows. So all in all, from a relative perspective, industrials also not a super strong sector. Add to that the potential double top that is forming here, and we have a bit of risk on our hands. And then here's technology. The only sector that's moving higher, and it's moving higher rapidly and strongly. As a matter of fact, because I'm recording this on Monday after the market closed, so this is only Monday, but this is last week's bar. And what happened is that we're breaking out on the upside out of an already rising channel, and that is usually a very strong sign. It calls for an acceleration of the move. So if that happens, we may see a little more upside in both technology, but probably also in the S&P 500, because it's such a big sector. Nevertheless, the entire story of the weak breadth, the narrow footing, the narrow foundation still stands despite this move higher. So again, I don't want to swim against the tide, but it is something that's worrying me. Relative strength, obviously, it's the only sector that is on a strong footing from a relative perspective. So you see the breakout here, you see the RRG lines pushing higher. And then here's consumer staples. Broke out, is now hesitating, still within the boundaries of the rising channel, hesitating above the breakout level. Maybe you could, if you really want, you could put it probably here, but let's not do that. But also the relative strength line is, is this breaking? It is very, very close. I mean, if we put in a low here and we start moving higher and we look back 3 months after now, we say, oh yeah, it tested support there. So this is where the hard part comes in. Is this a break or is this a test? I'm gonna give the staples sector the benefit of the doubt right now, especially because of the improving relative strength that you see. But it's not an all-out relative buy. As a matter of fact, the RS momentum is already rolling over. That's what we saw on that RRG, that it's actually rolling over inside the leading quadrant. Maybe it needs a little bit of digestion of the recent strength and that breakout level. Nevertheless, one of the stronger sectors at the moment, that's for sure. And then we have real estate. A very low reading on the RS ratio line, inside the lagging quadrant, picking up momentum. And you know, if you look at the price chart, it is very different from the others. I mean, most of the other sectors are pushing to new highs, already broke to new highs and are consolidating now there. Real estate did not do that. It actually it's at the same level as 2 years ago. However, it looks as if we're not challenging the lows. That is a good thing. And if you look in terms of relative strength, it's definitely still a relative downtrend. But look at the level of the RS ratio. This is around the same levels as we've seen over the last 5 years, where markets started to bottom. Now, there is no overbought, oversold on RRG lines, but I do keep an eye on, like, hey, what is a rough number where that RS ratio line kind of peaks and troughs. So you get a relative idea about where relative strength is bottoming. So with that RS ratio right here, we're at extremely low levels with RS momentum picking up, and the price chart, not the best, but if we take out that falling resistance line, I feel that there should be a little bit more in store for the real estate sector. So probably this one has already dropped so much that when money starts to flow out of other sectors, and right now that's probably only the technology sector, real estate might be one of the outsiders where things start to heat up. And then here is utilities, again, pushing against resistance, coming back down. From a relative perspective, this is not the worst chart in the book. You saw a bunch of relative lines that were breaking below previous lows, really, starting or confirming relative downtrends. Utilities is not doing that. It's still holding up above that previous low. It's inside the leading quadrant, so maybe we only need a little bit of a consolidation and a digestion of that up move that we had. Now, the one thing that caught my eye on this chart is the form and the shape of this correction. And I need to go to a daily chart to show you what I mean. So if I make this a daily chart, and I'm going to annotate this and add a trend line, then what this could potentially be is a falling wedge. And a falling wedge is a pretty bullish pattern. It's a trend continuation pattern. When it breaks out on the top of this pattern, that's a pretty bullish sign. The daily relative is absolutely horrible. We just nosedived into the lagging quadrant. But from a price perspective, I'm going to keep an eye on this potential falling wedge pattern, especially when it breaks out to the upside. It could give the utility sector a nice push higher. And then there's healthcare. Again, broke out to new highs, consolidating, pushing against overhead resistance. So from a price perspective, that's pretty strong. But the relative is, we broke support here. It's definitely still in a relative downtrend. We see momentum picking up a little bit. That's because of the sideways move here, but we recently dipped again. So from a relative perspective, unfortunately, not even the healthcare sector is going to be on the positive side of the RRG. And then finally, we've got consumer discretionary, one of the cyclical offensive sectors, and you see that last week and especially today, we're actually breaking away, but there is a lot of resistance already waiting very nearby. We're currently at 101, and this is 181, and we're at 185 where resistance is. We also broke below the late 2022 relative low, which is also not super strong. So we do need a little bit of work to get that back up. All in all, I hope you agree with me that it is all on a very narrow footing. The technology sector is definitely making a push here, but all the other sectors have a lot of work and a lot of risk in their charts, especially from a relative point of view. And that's it for this week. I hope you enjoyed this quick assessment of sectors and sector rotation. Please let me know in the comments how you feel about it, and share your opinion. I really love to read all of that. Don't hold back. And thanks for watching, and I hope to see you again next week, same time, same place.